Thanks so much for joining in for today's class. This is Management Decision and Control. And today we want to look at cost volume profit analysis. And we want to see how does this impact decisions that are made by management in organizations, and what can we be able to do with it as management accountants. We know very well that management decision and control equips us with the skills of management accountants to help management make decisions. But through that process, we use certain tools. And one of the tools we use is the CVP analysis. So as you can see, CVP is cost, volume, profit. We have three elements here. We have cost, we have volume, and then we have profit. Now, these are basically common terms that you have interfaced as an individual, but there is more to them. They are basically more to these terms. And I want us to first understand these terms in detail and see how we can be able to apply knowledge using these. So cost basically relates to what organizations incur in bringing goods into the finished goods status. So cost could be either they are variable costs or they are fixed costs. And we looked at the difference between the two. Cost usually forms a substantial part of a product's price, because most of the products are actually priced based on their cost. Volume, in this case, is also representing quantity. Volume is representing quantity. And then profit, we know that profit is total revenue minus total costs. So we want to see how does cost, profit vary when it comes with volume. So I just want to demonstrate that right here on IPC. So we say that cost would either be variable costs, but they can also be fixed costs. In fact, total cost is usually given by the total variable costs plus total fixed costs. That is how it is. Now, they have also told us about quantity. One thing that you also need to know is that this so-called total variable cost is usually given by the variable cost per unit, the variable cost per unit multiplied by quantity, the variable cost per unit multiplied by quantity, which is our volume in this case. Okay, so this means that our formula will actually can also be represented as we can have VC plus our so-called FC, fixed cost. So it can be represented by this. Total cost is equal to the variable cost per unit times quantity plus fixed costs. Now, the variable costs, we know very well that variable costs vary with quantity. Variable costs vary with quantity. So if variable costs vary with quantity, what this means is that if you want to determine the total variable cost, we get the variable cost per unit times the quantity. I guess in example, if you're looking at maybe production of water, if a bottle of water costs us maybe 900 shillings in producing it, if you want to determine how much a carton of water costs us in terms of variable cost, we shall get the 900 times the number of units in a carton. That is how we come to this. But it's also very important to also appreciate what happens with revenue. Now, revenue is usually a function of price and quantity. If you want to determine how much you have made in terms of revenue for selling water, you get the unit price times the quantity that you have sold. So this same revenue can actually be demonstrated by in short form as P times quantity. And this is total revenue. So we have also said that profit is usually given by total revenue minus total costs. So what this means is that profit can also be given by, so I'm going to replace this. I'm going to bring this price times quantity and put it there and subtract my so-called VC times that. But for me to do this mathematically, I'll put this in brackets so that I'm able to distinguish my so-called total costs. So that is what I'll basically have. Now, the CVP analysis, which is cost volume profit analysis, is saying that profit, the profit have basically depend on volume. This volume is basically an independent element. Well, cost depends on volume and profit depends on volume. As we can see, the higher the quantity, the higher the total cost. The higher the quantity, the higher the total cost. And similar to here, profit, we see that based on how this is structured, the higher the quantity, the higher the profit. So CVP tries to analyze how does cost vary when it comes to volume, and how does profit vary when it comes to volume. So that is the key aspect when it comes to the CVP analysis, being able to analyze how volume affects cost and profit. So one of the things that we shall also appreciate is that the relationship between cost, volume, and profit is different in the short term compared to the long run. In the short term, we see that profitability is more sensitive to sales volume, meaning the higher the volume, the higher the profitability. But that changes with time, and as we're going to see, demonstrated by what we call our CVP curve, okay? Because we have said that profit is given by total revenue is it minus total costs. And this is our profit formula. So we are saying that in one or the other, we need to analyze and see what exactly happens when profit, what happens to our profit when volume increases beyond a certain level. So I want to draw your attention to the pictorial that we have here. So we have our CVP graph, as we can see here. And down here, we have units on our x-axis, and then y-axis. We are basically catching up. We are basically catching up. This is just something to do with cost and revenue. The y-axis represents cost and revenue. So let's start from 0 here. As we can see, starting from 0, we see that our revenue grows with quantity. The revenue line that I'm talking about, is this line, this first line that comes from 0 to up. That is the revenue line from 0 right here to right there. That is our revenue line. Now we also have the cost, the total cost line. This is the total cost line, the one that is coming from 10,000 and going up. So what this means is that at 0, if quantity is 0, we basically have 0 revenue. But that is not the case for our so-called costs. At 0, we actually have already a fixed cost. We usually have this so-called fixed cost. Remember, we are trying to look at quantity versus revenue, cost, and profit. So we are saying that as profit increases, as our revenue increases, our quantity is also increasing. And that is also demonstrated when it comes to our formulas. I'll give you an example. If today you're starting from, let's say, let's look at our total costs. We've said that our total costs are given by the variable cost per unit plus fixed cost. So it means that at quantity is equal to 0, if your quantity is 0, means to be total cost will be where you have VC would actually it remain, but you have 0 times the VC plus fixed cost. So you're going to see that if your fixed cost, let's say, if our fixed costs were at 10,000, okay, and maybe our VC is at, the variable cost per unit is at 5. It means you're going to have total costs to be 5 times 0 plus 10,000. So at the end of the day, your so-called total cost at quantity is equal to 0 is actually equal to the fixed cost, because any number times 0 is 0. That is what is happening here. So, and that is why you see when it comes to your curve, when we are starting our curve here, this starts at 10,000 already, and they have called this the fixed cost. The 10,000, the distance from here to here is the fixed cost. Okay. And then we also need to appreciate. We do need to appreciate that this, as revenue grows and total cost grow, there is a point in time when these meet. Just imagine a new business that is starting today. If you opened a new business today, remember you'll incur costs despite you selling. And this cost could be the cost of rent. You've already made a payment for rent even before you start selling. So payment like for rent is a fixed cost. But as you sell, you have some variable costs that will start coming up. And this variable cost will be based on the units that you're going to sell. Are we together? This could be the cost of the materials you're going to use in production and so on. Now, remember, your revenue will start from 0 and it will keep growing, but your costs will start somewhere because you have some initial costs that you'll incur. So we are saying that as your revenue grows and your costs grow, there is a point in time which is called our break-even point, when your total costs will equal to your total revenue. There is that point in time when your total cost will equal to the total revenue, and we call that break-even point. We call that break-even point. So when you come to this, we've said that our total revenue is this and our total cost is this. One thing that you need to know that at break even, at the break even point, total revenue is equal to the total costs. So this means that P times Q is equal to P times Q is equal to our so-called costs here. Let me just try to pick this up here. P times Q is equal to that. So this is what is at this point in time, this break even. Now, from layman's understanding, you'll actually realize that if total revenue is equal to total costs, the profit is 0. If total revenue is equal to your total cost, your profit is 0. And it is from this break-even point that the business now starts doing what? The business starts to make profits. That is how businesses work. It starts, it's making costs, it has costs, its revenue keeps on growing. When the revenue reaches a point in time where it matches its costs, that is the break even. And beyond that, beyond the break-even point is what we're calling our profit area. So here the business will start making profits. You'll actually realize, like we said, that the CVP analysis is very relevant in the short term. We know very well that definitely businesses do not make profits forever based on the life cycle of businesses that move from introduction, growth, and then maturity, and then decline. We know that at the time B, our profits will actually go down. Our profits will actually go down. But before that, let's try to appreciate this. So we are saying that at break-even point, total revenue is equal to total cost. So what this means is that if we want to determine what we call the break-even quantity, if you want to determine the break-even quantity, or what you might call quantity at break-even point, or volume at break-even point, what we are going to do is we are going to get this this equation up and make quantity the subject, and make the quantity the subject. So what I'm going to basically do, I'm going to pick this as it is here, and I'm going to work it around. So since I have Chu here on this side and also have Chu here, what I'm basically going to do is I'm going to bring this VC Chu this side. So this is what I'm going to have. I'll have my P minus VC times Chu, and we'll equate it to FC. P Chu minus VC Chu is equal to FC. Remember what we said, P is price, Chu is quantity, VC is variable cost per unit, Chu is also quantity, FC is fixed costs. So since I have Chu here and I have Chu here, I'll go on to make Chu, to take Chu out of the bracket, and I'll have P minus VC. So P minus VC is equal to FC. So what this means is that my Chu is actually the same as, now I want to divide through by PVC, okay? So the end equation that I have is FC divided by P minus VC. So this is what I'm going to basically have. FC divided by PVC. So if I want to show this in full, I'll say that at my break-even quantity is usually given, I'll say Chu, oh, okay, it's already, we've said quantity, will always be given by fixed costs, and these are usually total fixed costs, okay? Total fixed costs divided by price minus the variable cost per unit. That is what would show with our break-even quantity. Okay, break-even quantity. There's something that we also you also need to know. Remember, we say that our total revenue is given by price times quantity. Okay, so if you ever want to determine what you call break-even break-even quantity, this will always be given by this. Remember, okay, we have break-even quantity, but if you want to determine what we call the break-even revenue or revenue at break-even, you come and substitute where there's quantity here, you come and put all this. So it means that if I want to determine break-even revenue, it will be price times my so-called quantity, which quantity at break-even is given by all this. Are we together? I can even put this in bracket. So this is in bracket. Price times total cost over total fixed cost over price times this. So this is my break-even revenue. This is my break-even revenue. Remember, they told us that at break-even, profit at break-even is actually 0. The business is not making any profit, nor is it making any losses. Basically, the profit at a point in time like this, of course, it's making revenue and it's also making losses. But when you get the difference between those two values, you actually come to 0. That is what happens with this principle. But also, like I said, taking into consideration that businesses vary in terms of how they perform in the long run, okay? And this because of the different, what can I say? You know that businesses do not make profits forever. Even after break even, where are we saying that these businesses will continue to make profits? We have another thought. We usually call it the economic CVP curve. Now, the economists have another interpretation of CVP. They have another recommendation of how a curve should actually look like. So for them, they do believe that the whole aspect of businesses making profits and so on changes with time. Okay, just want to show you something. I'm just trying to, I want to show you how this curve looks like. So they take into consideration this aspect that although businesses will start making profits at top point time A, this profit will only be in the short term. And in the long run, these businesses will again get into making losses. So they do believe that businesses have what we call 2 break-even points, where they again get into a loss-making position. Okay. I hope you can see my screen here. I don't know if this will show you very clearly. Yeah, but as you can see here, this line here being our so-called y-axis and this being our x-axis, the economists say that break-even will have the first point of break-even. when businesses start making profits, because they start at losses, then the revenue grows, and they reach a point in time where they actually start making profits, and that's the break-even point. But they believe that this business will grow up to a certain level. So they will make profits up to a certain level. Why? Because they take into consideration the aspect of the life cycle of businesses, understanding that at a point in time B, these businesses will be faced with competition. They'll be faced with maybe internal challenges, in disaster, and so on. But just even the life cycle of the product in the market, the demand for the products will decline at a point in time A or B. So that's why we have the break-even point 2. So at this point in time, we shall go back to a level where our total costs will be high. As you can see, the total cost curve after this point 2 will now be up compared to the total revenue. As total revenue is falling, total cost will increase at that point in time. So when it comes to the CVP, we have 2 theories. We have what I showed you earlier on that gives us a so-called single break-even point, is what we call the accountant's model. So the accountant's model, for it assumes that it's a straight line, that revenue and total cost will be a straight line, and we only have one break-even point. And that's why it looks like this, compared to what the economists are actually saying with this. Are we together? I'll provide you with notes that have these 2 curves for you to appreciate how these vary accordingly. Now, one of the things that I also want to share with you is that we have what we call, after we have determined our break-even quantity, as we can see there, there's what we call contribution. There's what we call contribution. And contribution is a term that you'll interface even as you study the management decision and control. So contribution is price minus variable cost per unit. That is contribution. If you want to get total contribution, then definitely this will look at the total revenue minus total variable costs. Contribution is similar to profit, although contribution is what we get before we deduct the fixed costs. If you just get total revenue and remove your variable costs, you actually come to what we call total contribution. Now, as you can see from our formula here, we have our break-even revenue to be price times total fixed costs divided by price minus variable cost per unit. Similar to here, break-even quantity was given by this. Now, if we want to write our break-even quantity in terms of contribution, we can come and replace. You see here where we have price minus variable cost per unit. We can actually come and do this. We can come and say our break-even quantity will be given by our total fixed costs divided by variable. Sorry, let's call it contribution. Contribution, can even call it contribution per unit. So this is how our break-even quantity will look like when we looking at it from the perspective of contribution. Similarly to our revenue, in case we wanted to show our revenue will definitely be price, our so-called revenue here will be total fixed cost divided by contribution per unit. So this is how it will look like, basically. So contribution is a very key term that we need to understand. We need to understand. Okay. I hope we don't have any questions up to that level about how contribution comes in. Now, I want us just to look at an example at break of CVP, okay? Example of calculating the break-even quantity or the break-even point. As I get the question, I said, if you have any questions, you can be able to ask at this point in time. Okay. Just a moment. Okay, as I try to get the question, I also need to clarify something here that there is also what we call contribution per sales ratio. Is what we call contribution per sales ratio or contribution to sales ratio.
Excuse me.
Yes, Ojwanga.
I was trying to raise my hand.
Sorry,
No.
I think I missed that.
Okay. Maybe before we continue with the contribution, I just wanted to understand what it is and why is it called like that, so that as you continue with it, I can help you follow it.
Okay, I basically say that contribution is is basically trying to look at what is the difference between the price and your variable costs. So if it's about in terms of definition as per se, contribution basically represents the portion of sales revenue that is not consumed by variable costs. That is why when we're calculating contribution, we basically look at total revenue and total variable costs. We're trying to say, if you get your total revenue, for example, I'll give an example. Like I said, if it's a bottle of water, if we have spent 900 as our variable cost, and we sell this bottle of water at 2,000, definitely the difference between the 900 and the 2,000 is 1,100. Now that would be the variable cost. That would be the contribution. But that does not mean that it is the profit. Why? Because we have fixed costs that we have not taken into consideration. So contribution just gives us a picture of how much remains when we remove our variable costs before we even take into consideration our fixed costs. Okay. Contribution could also you could look at it from the perspective of we have profit. Okay. I don't know if from accounting perspective, just like the way we have gross profit, where we look at revenue and remove cost of sales. So contribution is like similar to gross profit at that level. So I hope that gives you some degree of understanding.
Yes, that's clear.
Okay, that is fine. Okay. So I hope is really alone that is getting confused on that. Okay. So let's look at a number here. Okay. Let's look at a scenario. A company ABC Limited sells shirts for men. Okay. The price per shirt is 20,000. Its fixed costs 100,000. Well, the variable costs per unit is 15,000. Okay. That is what we basically have. So we are saying that ABC sells shirts for men, price that, fixed cost that, well, variable costs is at 15,000. Now, let's try to calculate a few things. Okay. We are going to calculate first is the contribution per unit. The contribution per unit. So we say that this is usually given by price less the variable cost per unit. So in this case, it will be 20,000, which is the price, less 15,000. So the contribution per shirt is actually 5,000. That is what we have as a contribution per shirt. Now, the other that you ask yourself is, what will be the break-even quantity for such a company? In simple man's language, at what quantity will ABC start making profits if that is the data that it has? Okay. Now, we know our break-even formula, where we say that if you want to determine your break-even quantity, what you basically do, your break-even quantity, break-even quantity will be given by total fixed costs divided by price minus variable costs. So it means that this will be given by the 100,000, which is our fixed costs. This is to be divided by price, which is 20,000 minus 15,000. So this will give you 100,000 divided by 5,000. And at the end of the day, what shall we get? 100,000 divided by 5,000 gives you 20. So the break-even quantity is 20. You can even go ahead to call them 20 units or 20 shirts. That is the break-even quantity for ABC. The examiner can ask you to calculate what you call break-even revenue. So we say that revenue is given by price times quantity. And price, we have a price per shirt, which is 20,000. So this means that this will be 20,000 times our break-even quantity. Now, in this case, we already have a break-even quantity, okay? Because when we're calculating break-even revenue, where there's quantity, we use the break-even quantity. So here we can multiply directly and come to our 400,000. But it is the same thing that, or the same solution you will get if you come and calculate this directly using this. I'll give you an example. If I want to use this formula, I'll just come here. My price is 20,000. So this is being multiplied by total fixed cost, which is 100,000. And this is going to all over. We are dividing this by contribution per unit. I already determined my contribution. My contribution was 5,000. So in this case, I'm even using contribution instead as my formula. So what I'm going to get here, $20,000 times this divided by this, we shall have about 2. Okay, let me just do it here. So this will be This will be 2 billion. Hope we've done the right thing. Divide by 5K. So this will be this, divided by this. So it will get you to 400K, which is the same answer that we actually got. Got where? Got here. But here we're just trying to apply the formulas and see how that comes into play. So that is how the break-even revenue comes through and how this comes through. You may not, you don't have to cram this formula, but you understand it. And you can easily be able to put down the information as and when it is needed, okay? So I want us to look at something called target profit. I want us to look at something called target profit. Now, our businesses can have a target profit. And what this means is that businesses can say, I want to get, let's say, I want to make maybe 20 million this year. So that is their target profit. And the question they might have, is, what is the number of units that I need to sell to earn a certain amount of my revenue or my profits, okay? Of course, if it's target revenue, to be looking at revenue. If it's target profits, looking at profits, okay? If I proceed, I need to just answer this question. Somebody's asking, saying, what's the difference between total revenue formula and break-even revenue? Now, I say that total revenue is actually given by the same, is given by price times quantity. That is the standard total revenue formula. When we are asked to calculate break-even revenue, we use the same formula, but when it comes to where there is quantity, where there is this quantity, we now use the quantity of break-even, the break-even quantity. So what somebody may say is equal to price times the break-even quantity. Okay? So somebody was asking, what's the difference between the two formulas? So that is what happens. So that's the relationship. So that's why here we use the break-even revenue. When we calculate break-even revenue, we use the quantity, the break-even quantity, which was 20, which we had calculated in the previous part. Okay. So I hope, Jane Francis, that answers your question. So back to what I was saying, that an organization can have a target profit. For example, ABC can say that they want to earn 2 million by the end of the year. So that's what they want to earn. Remember, they're dealing in shirts. They sell each shirt at 20K. The shirt costs them 15,000, and they have fixed costs of 100,000. They want to make a profit of 2 million by the end of the year. They're going to ask you, how many shirts should they strive to sell to make 2 million? So we know very well that profit is given by total revenue minus total costs. Profit is given by total revenue minus total costs. So we also say that our profit can also be represented by this. Where we have total revenue, we can put P, which is price times quantity. And where there is total costs, we can do this, open bracket, VC, which is the variable cost per unit, times quantity, plus our so-called fixed costs. So remember, they want us to determine what quantity they need to sell at that target profit. So this means that we have our profit. Remember, we also have the price. We have the variable cost per unit. We have the fixed cost. So we can substitute into this formula and determine the unknown. So if I'm to substitute here, this is how it's going to be. 2 million is equal to, I'm substituting the profit is equal to price, which is 20,000, multiplied by quantity, which is what I'm looking for. And I'll call it my target quantity, since it's related to the target profit, minus, okay? This is minus variable cost per unit, we said is 15,000, times quantity that I'm looking for. And it's the same quantity at target profit, plus my fixed cost, which is 100,000. So I've just tried to substitute the information that we have there. And I remain with my QT to be the unknown. And what I will just do mathematically is to calculate the equation. And this is how it will look like. My 2 million will now equal to 20,000 Q minus 15,000 QT minus 100,000. Remember, when you're opening the bracket, what is in a positive here will become negative. So this is going to be this. I'm going to have 2 million equaling to 5,000 QT, because 20,000 minus 15 gives you 5,000. Minus 100,000. So I'm going to arrange, I'll leave QT alone, and this is what I'm going to have. 5,000 QT is equal to 2 million plus 100,000. So at the end of the day, my QT, which is the quantity at break even, will be given by, to be given by 2.1 divided by 5,000. So this will be this. divided by this, which gives me what? It gives me 420 units. So what does that 420 units represent? It represents the number of units that ABC has to sell. 420 represents the number of units that ABC has to sell if it is to make the 2 million profit. If it is to attain its target of making 2 million as a profit, it has to sell 420 shirts in the year. Okay, yeah. In case look at if they have a uniform month sales, so this divided by 12 means that these guys have to sell over 35 shirts in every month if they are to make that target profit. So that's how target profit comes in when it comes to the CVP. Okay, when it comes to the CVP. Now, the target profit, just like we have target, just like the way we have what you call contribution and profit, you can also have what we call target contribution. Okay, we can have what we can call target contribution. Now, I want you to just see something small here. If we are saying that our target profit, I'll bring this formula here and say that our target profit is given by this. This formula can be expound. I just want us to to bring in the idea of target contribution. So we can expand this formula and definitely remove this VC and put a negative here. I'm just removing the brackets. So I just want you to look at this. So this P2 minus VC2 is contribution. So this formula can actually change like this, where there is P2 minus VC, this can actually be called, you can call it target contribution. Sometimes, yeah, it can be target contribution, or you can call it contribution. So target profit can be target contribution minus fixed cost, because we say that contribution is the difference between your total revenue and your total variable costs. So the target profit can actually look like that. Are we together? Now, or else, what we could also have here, in case we want to maybe make this look even differently, just want you to look here. We have target profit equaling to P2 minus VC minus that. So I can have this formula adjusted where I'll put Q out of the bracket. So I'll put Q into bracket P minus VC. So I can adjust my formula to that. Okay, just mathematically, there's nothing much. And if I'm adjusting my formula to that, I can also, remember this Q is the target quantity, okay? This Q is the target quantity. The Q is the target quantity. So if I want to make my so-called Q the subject, what I can do is I can take the fixed costs that are negative this side. So I'll have Q in bracket P minus, P minus VC is equal to target profit plus fixed costs. And this will be, if I want to make now Q the subject, I'll say Q will equal to, so I'll put it here, is the same thing as target profit plus fixed costs divided by okay, let me put this P minus VC before I proceed. So you can have something like that, and this could be modified again more, where there's PVC, P minus VC, you can go on to call this contribution per unit. So in simple terms, your target quantity can be given by this. Target profit plus fixed costs divided by contribution per unit. You'll be able to find these within your notes. I tried to include these here in the notes. So when you go to your notes, which I'll be giving you, you realize that your target number of units can actually be presented by fixed cost plus target net profit divided by contribution per unit. Okay, so that is what I basically wanted to demonstrate for you here. So after we have understood something to do with target profit, I also want us to understand something called margin of safety. Margin of safety. There's another term in CVP which we call margin of safety. Now, I hope you remember our curve, which I showed you. I'm going to bring this back to the screen. So looking at our curve here, okay. We have what we call margin of safety. Now, margin of safety, of course, it's coming from the two words, margin and safety. Margin and safety. Now, businesses, when they start making profits after the break-even point, they're basically safe when they have started making profits. But at a certain point in time, maybe, for example, when you look at this, we see that this business, the break-even point is between 25 and 20, between here. let's say maybe the break, okay, this in terms of costs. But if you try to look at it from terms of units, the break even is when they are producing 50,000 units or selling 50,000 units. Now, the question will be, if at all we are producing at 70,000 units, what is our margin of safety? What is our margin of safety? So margin of safety is just trying to see how far are we from the break-even point, okay? Sometimes we say that margin of safety is how much output of sales level can fall before a business reaches its break-even point. Means like, if our break-even point is 50,000 and we are at 70,000, our margin of safety is 20,000 units. If we ever fall from 70,000 by 20,000 units, we are making losses. So 20,000 is our margin of safety in terms of units. Are we together? So if you're trying to look at margin of safety from the perspective of formula, okay, I will have two things. There's what we call expected quantity, which is like the 70,000 that I am at in the demonstration that I just showed you, the 70,000 units. But we can be able to look at also understand that we have what we call the break-even quantity, which we calculated for ABC case. So margin of safety, we are saying margin of safety, and this is in terms of quantity, is usually given by expected quantity or current output minus the break-even quantity. So that is how the margin of safety formula is written. The expected quantity is in terms of what is your level of production at a given point in time, and what is the break-even. So the difference between the two basically will give you what you call margin of safety. Now, this margin of safety can also be expressed as a percentage. The margin of safety can also be expressed as a percentage, and this is how it will look like. The margin of safety can be expressed as a percentage, and if that is so, we'll have this. We'll have expected quantity minus break-even divided by break divided by our so-called expected quantity, and we shall multiply everything times 100%. We shall multiply everything times 100%. So that is when we are doing our margin of safety. So I believe that you understand what margin of safety means. So the examiner can ask you and say, for example, the question of ABC. ABC is currently producing, let's say they are currently producing, let's just try to pick information from up here, which we had done. So they're producing shirts at 20K, fixed costs 100, variable costs that, and we got their break-even units as 20 units. So if ABC is producing or is producing or selling producing, let's say, 45 shirts. Okay. They can ask you to determine the margin of safety for the company. They can ask you to determine the margin of safety of the company. One, in terms of quantity. So if it's terms of quantity, you just do directly, you get your expected quantity minus break even. Expected quantity is 45. Subtracted, we subtract, remember we got our break even quantity to be 20. So subtract 20. And this gives you 25. So the margin of safety for ABC is 25, which basically means that this business can fall by 25 units before it reaches the break-even point, or before it starts making again losses. If this was to be in percentage, this would be very easy as well. You just be able to substitute it here and multiply by 100%. Okay, so that is what happens with the so-called margin of safety. Okay, now there's another term that I want us also to look at. There's another term that we also call contribution per sales ratio. Contribution to sales ratio. Now, contribution to sales ratio is usually given by contribution to sales ratio is usually given by, we will have our contribution as our numerator. Okay. And this will be contribution per unit. This will be divided by so-called selling price. The selling price. That's how our contribution to sales ratio will look like. If you're looking at it from total contribution, to be total contribution divided by total revenue, okay? And if it's per unit, then we look at it from that perspective. Now, why am I bringing up this? Is because we have a formula. Like I said, let me just try to do this in case you're trying to look at it. I said you can, this CS ratio can also be represented by total contribution divided by your total sales revenue. Okay, remember the factor here, the multiplying factor is quantity. When you multiply contribution per unit times quantity, you get total contribution. When you multiply selling price times quantity, you get to sales revenue. That is why the two formulas give you the same value. But what I wanted to bring to your attention here, sometimes the break-even point or our break-even quantity can be shown in terms of CS ratio. Now let's just pick the break-even quantity formula. So this is our break-even quantity formula. So if you want to show the break-even quantity formula in terms of the contribution to sales ratio, remember, we have the contribution per unit. We have a contribution per unit there, which is the price minus variable cost per unit, but we don't have our selling price, okay? We don't have our selling price here. So what is going to happen is we are going to multiply, okay? I don't know if you remember something called reciprocal. Reciprocal. So reciprocal means you divide 1 over the number, okay? You basically divide 1 over the number. So what is going to happen here? Let me multiply price this side and also multiply price this side. So what is going to happen here? I want you to look. I'll have my break even quantity times price is equal to, I also want to multiply this by price. Okay, I'm just trying to adjust my formula. Remember, we say that break-even quantity times price gives you what we call break-even revenue. Gives you what we call break-even revenue. And break-even revenue is given by total fixed cost times price. This. So what I want to do, I want to get this from my what? From my formula here. But let me first put it right so that you're able to see something. So this is total fixed cost times that. I'm going to change this to contribution down. So this will be contribution per unit. Price minus variable cost per unit gives you contribution per unit. So what this means is that break-even revenue is equal to total fixed costs times price divided by contribution per unit. But remember, our CS ratio is contribution per unit divided by selling price. By this time, the selling price is the one that is up. This price is the same as the selling price, okay? I can even just call it selling price for you to know. So this is the same thing as the selling price. Because we don't have a buying, like its price is the selling price. So what happens here is I can be able to just separate the fixed costs, okay? So I want to, I'm going to create a reciprocal. What I want, this is what I'm going to have. My break even is the same thing as total fixed costs divided by 1 divided by So I've talked about a reciprocal, okay? And maybe before we come here, let me first color this. I want you to agree with me that if I have one number divided by 1 out of 5, 1, I don't know how I can show it here. If I divide 1 divided by 5, okay, definitely I get 1 over 5. But if I get 1 and divide it by 1 over 5, divided by 1 over 5, okay? It's even giving me May. 1 divided by 1 divided by 5. You press your calculator. Let me just try to show it on your on the calculator. So this is what I'm saying. If I get 1, let me just try to rub all this history. Okay. So if I get 1 divide by, okay, let me do this. I want to just show you how reciprocals work, especially for my friends that didn't do mathematics. So 1 divided by 5 gives us 0.2. We all agree? 1 divided by 5 gives us 0.2. Now, if I divide 1 divided by 1 divided by 5, it's like dividing 1 divided by 0.2, because the 1 divided by 5 is 0.2. So when I divide 1 divided by 0.2, I actually come to 5. So when you divide 1 divided by the reciprocal of a number, you actually come to that same number. So this is what I'm trying to mean here. So if I have 1 and divide it by 1 divide by 5, okay? Let me remove this. This gives me 5. Okay, when you try to press your calculator, because you first calculate the 1 over 5 and then do 1 divided by 1 over 5. Now, why am I going into these details? Remember, what I want, this is the formula I want. I want to have this formula of total contribution divided by, okay, let me use this. I want to get contribution per unit divided by selling price. But in my last formula here, I have selling price up and I have contribution per unit. Yet my interest is to have contribution per unit up and then selling price down, so that I can introduce what I'm calling my so-called contribution per sales ratio. Okay. So if I want to do that, if that is what I want to do, basically, I'm going to do the reverse. Okay. Because ideally, even before I did this formula is the same as total fixed costs times, just want to separate this formula to remove my selling price divide by my contribution per unit. I'm just trying to separate this so that I'm able to have this as a separate formula. So what I'm going to do is, my interest is to have contribution come up and selling price come down. So this will be the same thing as times 1 divided by this whole thing. So 1 divided by selling price divided by contribution. If I want it to look like what I have here, so if I have something like this, 1 divided by contribution per unit divided by selling price gives me the same thing as, it's the same thing as what I've written up. To those that are getting confused, I'm sorry, but you'll be able to learn this as we proceed, okay? So if I have something like this, it is the same thing as this, okay? When you do 1 over something, it's like interchanging it, okay? Those that did mathematics, this might be coming up easy. So if we say that contribution per unit, this is also the same thing as CS ratio, what this formula will turn into will be 1, which we have there, divided by, so wherever there is this contribution per unit divided by selling price, I'm going to replace it by what I'm going to call my CS ratio, which is also the so-called contribution per sales ratio. So when you have your total fixed cost times 1 divided by CS ratio, it's the same thing of you having total fixed costs divided by CS ratio. So why am I going this far? I'm just trying to modify the break-even revenue. That our revenue can actually be given by this formula, can be given by total fixed cost divided by CS ratio. You'll be able to find this formula within your notes. But I was just trying to labor to explain how we actually come to the same. So you'll see that in your notes, break-even sales revenue can actually be given by fixed cost divided by contribution to sales ratio. So when you see this somewhere, or the examiner, instead of giving you the details of variable costs, the price and so on, if they only give you the CS ratio, then you can determine the break-even sales revenue. So that's what I was trying to labor to arrive to, okay? So I hope that it's something that is you've gotten. Ojwang, was this clear? Just hear from one of you.
Yeah, that's fine. That's okay.
Okay, fine. So that is what I was trying to get to. So CS ratio is very important. Okay, CS ratio is very important. Like CS ratio is the contribution to sales ratio. And somebody says CS ratio is contribution to sales ratio. And what it's trying to just look at, like we said, contribution is looking at to what extent, basically, what extent are your variable costs vis-a-vis your sales revenue. So the CS ratio is trying to measure how much contribution do you earn from each unit of your sales. From every shilling or dollar of your sales, how much contribution do you earn? Okay, so that is what, so CS ratio can also be, we can have it within the break-even formula, okay? Yeah. So that is our break-even point in terms of what we have. So CVP, these I'm going to share with you. At least we have been able to go through each of these, the contribution sales ratio, the target profit, margin of safety. So these notes will help you with the with your reading, with the details in terms of how each of them play. Okay, I've tried to put down some explanations that can help you We also have what we call objectives of the CVP analysis. Like I said, our intention is to evaluate how cost revenue is varying when it comes to volume. And I said the word volume is also used to mean quantity. Volume, the cost volume profit analysis can also be used in setting up flex budgets. We shall be able to understand flex budgets when we look at the topic of budgeting. But we can also use it for evaluating performance for purposes of control. And then also in setting prices, and we shall see how that also comes through. Okay, we looked at the target profit and we've seen how it comes, and now we can also show it in terms of contribution. The same thing with margin of safety. We've also been able to learn how we can do it in terms of quantity, but also in terms of units and what it means. So the literature will be able to help you accordingly. And one of the things that we say that if your margin of safety is unsatisfactory, which basically means if you're few units away to your break-even point, okay? Like you surpassed your break-even, but you're not far away from the break-even. So any point in time you fall to your units. For example, we saw ABC, their break-even is 20 units. Means that at 20 units, they are not making any profit at all. Neither are they making any loss, because total revenue is equal to total costs. So at that, if a business is producing at, let's say, 40 units, it is just 20 units away from its break-even point. So if your margin of safety is unsatisfactory, we have steps that you can take, either to increase your selling price, that will help you push you up, reducing your fixed costs, reducing your variable costs, substitution of existing products by more profitable, increasing your volume, modernizing your production, and so on. Okay, so that is very important. And then we also looked at the pictorial view of our CVP. I also showed you what how another kind of CVP curve can look like according to what we call the economics view of our CVP curve. So that is very important. Now, CVP has what we call assumptions. This CVP model has what we call assumptions. And those assumptions are very important because it's only within those assumptions that actually the CVP model is applicable. Okay, it's within those assumptions that the CVP model is applicable. So somebody is asking, what is margin of safety, the favorable margin of safety ratio? The favorable margin of safety ratio, of course, the farther you are away from the break-even point, the better. In terms of what is favorable really varies with say it really varies when it comes to different businesses, okay, and also based on different industries as well. Because with the margin of safety, we are saying, how are we safe? Now, our safety net is really dependent on very many things, okay? Our safety net is really dependent on many things. So depending on the industry and so on, that might really vary. That is what I can basically be able to say. So I'm saying that the CVP analysis has assumptions. And these assumptions have to be in place if you're to use this formula effectively. Some of these assumptions, CVP assumes that we have the same price. Basically assumes a stable price, which price keeps on changing. It assumes a stable price as an assumption, which we are saying that it also changes. Now, when you're looking at your assumptions, it's also very good that we look at them vis-a-vis what you may call the limitations, because the examiner may not ask you for assumptions, but they may ask you for limitations. So we're saying this selling price is assumed to be constant, okay? That's the assumption. But we know very well that we live in an economy where prices keep on changing, even for fuel, it's keep on changing. So the CVP model is not applicable where there are constant price changes. It's only applicable when the price is the same. The other is it also assumes that the variable cost per unit is constant. Now, the variable cost per unit also changes based on the change in the market. So in that case, the CVP model will not be applicable. It also assumes that fixed costs remain constant. Now, I say that as though the fixed costs are called fixed, it's not guaranteed that these do not vary. The fixed costs also do vary. And how do they vary? They vary in the long term. I give you an example. Today, you may be renting one room and you pay a fixed cost of, let's say, 1 million. But as your market grows, you may need an extra room, and this extra room may cost you 500,000. So although your rent has always been 1 million, in the long run, you may need to increase this to 1.5. So this can also increase, but also fixed costs are also subject to changes in the market prices. If today you're paying rent, the space is still the same, but the landlord has increased, the fixed cost has changed. So the CVP model assumes that these fixed costs will remain the same, which is not the case. It also assumes that the level of production is equal to the level of sales. Like what you produce is what you sell. And means that there are no changes in level of inventory, which is not true. Because sometimes you have wasted stock. Sometimes you have your production does not match your demand. You produce and that does not reflect into the sales. Okay. Yeah, and so on. It also assumes that inventories are valued at variable cost and fixed cost is treated as a period cost. And that's why we're saying that closing stock is carried over the next financial year, which does not contain any fixed costs. So those are some of the assumptions. And here I'll try to present them as limitations, but yours is to know that these are how the assumptions vary. Okay. Now, the other thing that I want to end with this class is that it's very important that you also know that we have what we call CVP for malt products. So a business may be producing more than one product. A case in example is Coca-Cola. If Coca-Cola is dealing in Sprite, Coke itself, Stoney, and so on, it may have a break-even analysis for its malt products. Okay, I've put something within the notes about malt products, CVP. It's very good for you to read in detail and understand that. We'll be able to do a number that can be able to give us an understanding on how this reflects in case we have an examination question. Okay. Yeah, but for now, you can be able to to have that. Then also, one of the things that you also find are the uses of the break-even chart. Now, like we're saying, this is management decision and control. And whatever we study, we want to see how do we use this in real life. So we have different areas here of how we can use the break-even chart. The break-even chart is what I showed you. Basically, the curve, the whole graph that we have showed you. So it can help us to show effects of changes in, let's say, profit as a result of volume. It can also help us to give us a correct picture of our variable costs per unit. It can also help management in efficiently determining how to determine marginal cost. Then we also saw that margin of safety helps us know how far we are from the break-even point. And their management, once they know how far they are from the break-even point, they can pull up their game and become better, okay? And so on. So those are some of those you find. I'm going to share this with you so that you can read through and conceptualize the notes, okay? And then if you have any questions, you'll be able to ask those as we get along on the WhatsApp group. Those that joined in this class late, the first thing that we did as we started, I was asking about if we had gone through the video that I'd shared on the WhatsApp group, and I had only one person, I think that was Sandra, who had indicated yes when we had about 2 or 3 people here. I want to say that we have this topic which is called relevant costs for decision making, and we did the first part of the class in the first lecture. And I shared with you a video so that you can be able to proceed from where we had stopped, because we didn't meet last time. So if you haven't gone through that video, make sure you go through that video. But also, that video was proceeding from relevant costing. It entered into another topic, which is control systems. So go through that video. I'm going to share another video for you to go through so that you finish the control systems. So I'll not be able to look at control systems again. So you have to get some time and go through. Create time. We have entered a new month, and happy new month to everyone. We have very limited time to the exam, so we don't want to take any chances. Once I give you some tasks, let's make sure that we go through them. Somebody will say that we want more examples, more examination-related examples. We cannot do them if we are not taking using the videos that we have. We are leveraging, because, for example, I have a video on CVP. So if I have to come here and I have to go through things afresh, means that you not benefit from the time we have, because if I give you this video and you have to go through before we come to class, means that I'll start immediately looking at past paper questions, and this will not only benefit me, but will also benefit you as well, because that means it's going to reduce on our time. So us having one time that we are meeting within 1 week, I want us to utilize another day within the week by going through this video that I'll be able to share on a weekly basis, so that we know that when we come to the class, we are following up from the knowledge that we learned through the video, and the live class is going through to answer questions, but also to elaborate something that is examination oriented. And that will help us to try out more numbers than us going through theory, and we have limited time to try out numbers, okay? So I hope that is noted. I just wanted to pass on to that message, especially for the students that are right here. So other than that, I want to say thank you and wish you well. I'll be able to share then the notes so that you can follow through. In case of any challenge, please reach out and let's see how we can help you. Thanks and have a good evening.